Hey guys, it is Julie here with JT.Wealth. In today's video, we are going to take a look at 5 Warren Buffett stocks that you can buy for under $25. So let's get into it. All right, guys, welcome back and thank you so much for being here. Like I said, today we are looking at 5 stocks that Warren Buffett holds in his Berkshire Hathaway fund. These all are under the $25 price point, so we're going to take a look at them and see if they still look like good buys. Now, these 5 stocks were highlighted in a recent Benzinga article by Wayne Duggan. And as he points out, CEO Warren Buffett is one of the world's richest people with a net worth of around $86 billion. Unfortunately for small retail investors who want to follow in Buffett's footsteps, buying even one share of Berkshire Hathaway is rather pricey. Berkshire's Class A shares trade around $345,000 per share, while the Class B shares meant for retail investors aren't necessarily cheap, trading around $230. But just because Buffett's company itself has a pricey stock doesn't mean that there aren't Buffett stocks out there to buy that are affordable. And just before we take a deeper look at the 5 stocks mentioned in this article, this is just your friendly reminder that if you enjoy today's video, make sure you give us a big thumbs up and leave your thoughts in the comments down below. Also, if you like free stocks and are looking to start a new investment account, check out some of the links in our description down below. Right now, Webull is giving away 4 free stocks just for opening an account and making your initial deposit, so make sure to check them out. Okay, now the first stock we're going to take a look at is Liberty Latin America. They trade under the ticker LILA, currently at an $11.80 price point. Now these guys are down about 30% from January highs of around $17. Taking a bit closer look at the company, Liberty Latin America is a cable, phone, and internet provider serving more than 20 countries in Latin America and the Caribbean. In line with its long-term strategy of rolling up assets in the region, the company has 2 more acquisitions that will expand its footprint. And late last year, the company announced a deal to acquire AT&T's Puerto Rican and U.S. Virgin Island wireless business in an all-cash $1.95 billion transaction. It's a solid strategic fit for the buyer. Once the deal closes, which is expected to happen this year, Liberty will be able to offer customers a triple play bundle, and those have proven to be effective tools for upselling customers on more services and keeping them from changing providers. So the acquisition will also expand the portion of revenue and earnings that the company derives from Puerto Rico, which has historically been a stable market to operate in relative to other Latin American countries. The island is expected to contribute more than $1.2 billion in revenue to Liberty's coffers annually, and the additional infrastructure on the island will prove some cost synergies, boosting profitability. And they are also acquiring Telefónica's Costa Rica assets. On July 30th this year, the company announced it was acquiring Telefónica's wireless business in the country, where it has been the second largest player, for $500 million. So this deal will serve a similar strategic purpose as the AT&T deal and will enable Liberty Latin America to offer more services to its Costa Rican customers. So definitely some recent positive catalysts for the company. And when we take a look at what analysts are saying, the company is rated as a strong buy based on 3 buy ratings. The average price target comes in at $14.33, which represents just over 21% upside, with the high-end target being $17. Currently, Berkshire Hathaway holds about 4.6 million shares of Liberty Latin America, worth just over $46 million. Second on our list today is satellite radio operator Sirius XM. Trading under the ticker SIRI, they are currently at a $6.42 price point. Now these guys are down just about 12.5% from their earlier year highs of $7.40. Now, Sirius XM is having a rough year, but that isn't a surprise, as it's a satellite radio provider in a pandemic. So considering diminished driving trends, sluggish new car sales, and the recession, there are several headwinds keeping the media stock in check. Now, the real surprise here is that if Sirius XM closes out the year with a loss, it will be the first time since 2008 that shareholders don't achieve positive returns from the stock. There aren't too many other stocks out there with an 11-year streak of gains, but every winning run has to end sometimes. But the good news here is that things aren't as bad as the stock price might have you think. Sirius XM saw its revenue climb a mere 1% to hit $2.025 billion in this latest quarter. But this is actually a good thing, as analysts were bracing for a 4% decline after a 5% year-over-year dip in the second quarter. things were kinder on the bottom line, with net income rising 11% to $272 million or 6 cents a share. Wall Street was settling for a profit of 5 cents per share, making this the second time this year that Sirius XM beat the market's profit target. On another positive, their guidance is finally inching higher again. They were only forecasting 500,000 self-pay net additions for this year, but on their last earnings report, they bumped up that tally to 800,000. Taking a look at analysts' outlook on the Sirius XM stock, it is currently rated a strong buy, and that is based on 8 analyst ratings. Average price target coming in at $7.59, which represents about an 18% upside. The highest target not being too far off at $8 per share. Berkshire Hathaway holds about 50 million shares of Sirius XM, valued just over $320 million. Next up is Teva Pharmaceuticals. They trade under the ticker TEVA and are currently at $9.48 per share. Now, these guys have a bit more of a volatile year. Currently, they are down about 30% from nearly $14 highs. And doing further research on this stock proved to be quite interesting, as there are some drastically differing opinions out there. First, it was included in 4 top value stocks on sale to buy right now, saying that value seekers would be wise considering digging into brand name and generic drug developer Teva Pharmaceutical Industries. Now, the reason that Teva is so inexpensive is because it's facing some near-term hurdles. Teva has been a lawsuit magnet as of late and is contending with allegations that it helped fuel the opioid crisis. The company also grossly overpaid for its Actavis acquisition and has been backpedaling because of the debt ever since. However, Teva's turnaround specialist CEO, Kerr Schultz, who was hired in 2017, has worked wonders. In 3 years, Schultz has Teva back on track and reducing its annual operating expenses by $3 billion, as well as lower its net debt by roughly $10 billion. Now, this has been done through a combination of asset sales, lower expenditures, and using positive operating cash flow to pay down debt. There's still plenty of work to be done, but Schultz has moved Teva well out of danger territory. So some positive sounding outlooks there. But on the other hand, they were also included on 2 stocks that could go bankrupt in 2021. Now, Teva's generic drug business is so widespread that nearly 10% of the generic drug prescription in the US each year are filled by a Teva product. Nonetheless, the company is barely profitable. Its revenue is shrinking, and it has $26.68 billion in debt, $1.6 billion of which is due in the next year. While the company's leadership recently attributed its shrinking revenue to the detrimental economic impact of the pandemic, the company's massive debt load is nothing new, nor is its narrowing margin. Simply put, it's extremely expensive to manufacture and distribute generic drugs at scale. Since 2016, revenue has been falling, and the company's high level of debt has become a larger and larger problem. So far, Teva has managed to navigate the issue by minting billions of dollars in new stock. Still, Teva didn't make any debt payments last quarter, and its free cash flows are dwindling. Teva's American business unit is also facing a federal criminal indictment that alleges violations of the Sherman Act, which provisions for U.S. antitrust laws against price fixing. So definitely some more concerning outlooks from that. And it's not surprising that when we look at analysts' outlook for Teva, that they come in with a hold rating based on 2 buys, 3 holds, and 1 sell. Now, their average price target comes in at $10.20, representing a small upside of about 7.59%. Now, Berkshire holds about 42.7 million shares of Teva, worth $400 million. Next up is Canadian energy company Suncor. They trade under the stock ticker SU, currently at $15.41 per share. Now, these guys are down about 55% from the start of the year when they were up above $34 per share. Now, the energy sector was one of the hardest hit during the pandemic, but recent vaccine news has renewed some hope with investors. In Suncor's September quarter, their operations fell from $1.66 billion compared with $2.675 billion in the prior year period. However, it was significantly higher than the $488 million figure in Q2 of 2020. Suncor managed to reduce operating and capital costs in Q3 and is on track to achieve its previously announced operating cost reduction target of $1 billion. It also expects to reduce capital expenditure by $1.9 billion in 2020. Suncor claimed it undertook significant maintenance activities across its upstream and downstream assets in the third quarter of 2020, which resulted in lower production volumes and refinery utilization. Now, regardless of its recent dividend cut, it's clear the market sees Suncor as a stock just waiting to bounce back. This is evidenced by its enormous upward momentum from the vaccine announcement. With oil prices starting to recover and stabilize, there's reason to believe Suncor could make a solid recovery through the year. If the stock can weather the storm until then, it has a good shot of returning solid value to investors. Of course, the hit this stock is taking shouldn't be understated. As of this writing, it carried quarterly revenue growth of negative 34.4%. While projections for next year are still positive, that's a bleak situation to be in at the moment. Even still, Suncor has valuable assets, and that means to ramp up production to given the opportunity. Cost reduction, which includes the cut dividend, will help this TSX stock bridge the gap until the economy is back up and running. And analysts are looking at Suncor's stock quite favorably. It comes in with a strong buy rating, including 13 buys with 2 holds. Their average price target is $18.83, representing over a 22% increase. Berkshire holds about 19 million shares of Suncor, worth about $296 million. And last on our list today is Barrick Gold Corp. They trade under the ticker GOLD and are currently at $24.28 per share. They are also the only stock on this list today that is actually up from the start of the year, as they're currently up about 30% from January. Now, Buffett has been historically skeptical as gold is an investment, so many were surprised when Berkshire Hathaway disclosed this holding earlier this year. Now, this stock recently went soaring because of surging gold prices being fantastic for their most recent earnings, and they've reported better than expected in their last quarter. So the Canadian mining giant posted an adjusted profit of $726 million, or 41 cents a share, an increase of 78% from last year and ahead of expectations for earnings per share of 33 cents. Higher gold prices produced record cash flow. The realized gold price in the quarter was $1,926, up from $1,725 in the second quarter and $1,476 in the third quarter last year. Now, the company has been making substantial headway on its debt. Higher realized precious metal prices, along with the company focused on the build-out of higher ore-grade mines, allowed it to reduce its net debt by 71% from the sequential second quarter to $417 million. Record free cash flow of $1.3 billion also doesn't hurt. Barrick Gold looks to be on the track to deliver with an all-in sustaining cost of just under $1,000 per gold equivalent ounce in 2020, with the real potential to push this down to an AISC of $900 per GEO in the future. This gives the company a comfortable cash operating margin between $900 and $1,000 per GEO, and it should allow Barrick to continue improving on its financial flexibility. Gold stocks had the potential to be quite lustrous with Joe Biden in the White House as well. And the outlook for this gold stock also has a decent bit of upside. With a strong buy rating coming from 6 buys and 2 holds, their average price target is $32.67, and that is nearly a 35% upside. Berkshire Hathaway holds about 12 million shares of gold, worth about $290 million. So there you have it, 5 different stocks that Warren Buffett holds in Berkshire Hathaway that you can get your hands on for under $25. Now, as you heard, some of them do have a bit of a mixed outlook. So as always, make sure to do your due diligence before making any trade. These videos are never a recommendation to buy or sell any specific trade, and this should always be done based on your own research. On that note, guys, I would love to hear your thoughts. Are these some stocks that you hold or would be looking to get into? Or are there any other Warren Buffett recommendations that you've loved? Always love hearing from you guys, so make sure to leave your thoughts down below in the comments. If you made it all the way to the end of the video here, make sure to give us a big thumbs up and that you're subscribed to the channel as well. Thank you guys so much for watching. I hope you have a wonderful day, and cheers.